Is the Fed afraid to raise interest rates? Because they have been telling us since the summer they were going to do at least one more rate increase, but yesterday they decided not to do anything at all. So what is exactly going on here, and how should we adjust our portfolios? Let's go ahead and break it down. Now remember, the Federal Reserve is the one in control of interest rates. These are the same rates that determine what you pay on your house, what bonds are paying, what your savings account is paying, and everything in between. And the entire point of increasing interest rates is to slow down the economy and to slow down inflation. That is what their job is, and they're trying to get it down to 2%. Trying to get inflation down to 2%. Last we checked, which was a few weeks ago, it was around 3.4, 3.7%. It has been flat at least the last two reports. So why y'all not raising interest rates? What's going on here? There are three primary reasons and three things they are looking at to determine why they're not doing anything at this moment in time. The first one is the economy. Remember, we just did a video earlier, was it last week or this week? Might have been this week. Anyway, I do a lot of videos, okay? We do 250 videos a year. But we found out that GDP, gross domestic product, the economy, in other words, grew by more than 4%. I think it was like 4.9% or whatever the exact number was, which is great. However, remember, they're trying to slow down things, right? So they want the economy to obviously grow, but growing by that much is more than what they expected. And they're saying, look, we have increased interest rates in the past. We expected things to slow down. They haven't. And the economy looks like they don't care, right? And the economy is still booming, which again is a good thing, but not necessarily the best thing for inflation. So that's one thing. That is one thing that's going to tell them that yes, we need to increase interest rates at least one more time. But you've got two things on the opposite side of the equation. The first one is increasing bond rates, which we had talked about before. It's one reason why the stock market has been down roughly 9% in the last 3 months, because as interest rates climb and we see the bond market becoming more attractive, people take their money out of stocks and go to bonds. It is relatively safer in comparison and is a little bit more stable. So why risk, trying to get 7, 8, 9% when you can get a near guarantee, not a perfect guarantee, but near guarantee for 5 and maybe 5.5% or more in some cases. So people are leaving the stock market and going to bond markets. But here's the thing about bonds that everybody doesn't always think about. Yes, bonds are paying more, but that means that the company that is issuing the bond also has to pay more. That is going to slow them down because that is borrowing costs for them. Bonds are liabilities to companies. They're assets to you. Okay, they are liabilities for the company, but assets to you. So when I issue a bond, if I'm a company, I'm loaning you money. And now instead of paying 1 or 2%, I'm paying 5 or 6%. That's going to tell me, hey, I might not want to borrow. And if I'm not borrowing money, I'm probably not expanding my company, which means what? I'm going to slow things down. If they are going to slow things down, one would assume they're not going to sell as much, which means that inflation should come down. So it's really kind of a domino effect here of what bond rates are doing. So that's one side of that equation. The other side is mortgage rates. Mortgage rates are extremely expensive. They are at a 25-year high, around 8%. Which is obviously very expensive in comparison. So remember, I got in this house in 2021. Our mortgage rate was below 3%. Okay, below 3%. And every 1.5% can add another like $300 or $400. I forget the exact number, between $300 and $400 per month. And now it's at 8. So houses are extremely expensive, which is going to have a trickle down effect too, which means that people should not buy houses at the rate that they have been before. So they are hoping that because bonds are becoming more expensive and because homes are becoming more expensive, that inflation is going to come down. Here's my issue with that. They can raise interest rates one more time, and we may find that out in December of this year. December 12th and 13th, I believe, is the next time we're going to hear from the Fed. So we'll see what's going to happen in roughly a month. But the thing here is the two biggest contributors to inflation don't really fall under the purview of interest rates. Gas prices, right, are one of the biggest things, and rent prices, right, how much it costs for homes. Now, yeah, the mortgage price, right, the interest rates for the mortgage might help a portion of that, but rent is not in that category. I'm not sure whether you raise rates or not, whether the people collecting rent are going to care, right? And then again, you have gas prices, which is really more of a supply and demand thing, and there's not much that the Fed can do. So that is my concern. Whether you raise it or not, those two factors, I think, count for close to 2/3 of the entire inflation number. So you can only control but so much. So that is my biggest concern there. When it comes to what we should do for the stock market and the economy, that one's a little bit more up in the air. It's really more of a stay the course because, again, in just a few weeks, right? It seems, yes, we just started in November, but again, we're talking December 12th or so. So we're talking, was it 45 days or so, roughly? We're going to find out whether they're going to keep rates steady for the rest of the year or not. So I'm not sure that there is a great, reliable strategy. You should sit down and change your portfolio up. But like I've said in previous videos, this is the time to just make a list and check it twice. No, it's not Christmas time yet, okay? We need to finish Thanksgiving and then we can put up the tree and all that kind of stuff. But you should be preparing to look at what you need to add to your portfolio, look at what you need to trim. Whether or not rates change, I'm not entirely sure what they are going to do, but I will say I am slightly concerned about this. Because of what the Fed has said, and because of the way the economy and interest rates and inflation and unemployment, all this stuff has been trending, the thought was initially they were going to raise interest rates at least one more time in 2023, which is not off the table, but mid-2024, like July and on, or June and on, the back half of 2024, they were going to start cutting rates. Well, now the question is that really going to happen or not? That is what I'm slightly concerned, and that's what I'm looking forward to now, is if they don't raise rates this year, now we roll into 2024, are they going to raise rates then? And if you raise rates in 2024, are they going to cut it in 24 at all, or are they going to push it all the way back to 25? And if so, what is that going to look like for the stock market and for the economy? That's far too far out for us to try and guess and figure out, especially again, when we're going to get some answer or some clarity on that in about 45 days or so. With all that said, there are a few things and strategies that you should be paying attention to, and if you're looking to buy a home, there are some things you should do as well, some of which we've covered already. I've already said, if you're looking to buy a house, ain't no rush. There should not be a rush to go in and pay 8% on a mortgage when you really don't have to, when the thought or the theory is things could get less expensive in 24. But again, we're going to find that out in December, what they are going to do and if they're going to hold things steady. I will say though, that based on what they are going to say in December, that could throw off that schedule, right? Because initially I said, well, wait until mid-2024 when we expect them to cut rates and then go buy, and then you can refinance if rates continue to fall. We'll see. What if that is now going to be pushed into 2025? Now, I don't necessarily think that is the worst thing in the world, but everybody's schedule and when they want to buy and why they want to buy is totally up to them. It's going to be an extremely personal decision, but I would rather save as much as I can, especially one of these high yield savings accounts, which we have covered before. That's going to pay you 4%, 5%, 5 and some change, and just continue to stack that and grow it for the next 6 months, maybe even the next year, and perhaps early 2025 is when you can start to, when it becomes a buyer's market again. We'll see. Right, a lot of this is still up in the air, but we are going to get some answers, thankfully, here pretty soon. In the meantime, though, again, the two things you need to do: look at your portfolio, start to make a list, and start to make a plan on what you need to do at the end of the year. And you might want to find a very good savings account to start to park your money now. I've covered an entire video on what the best accounts are, best savings accounts are right now, and you need to check that video out right now.